Most people view the stock market like a high-stakes casino. They chase the next 10x crypto token, panic buy overhyped AI stocks at an all-time high, and lie awake at 3 a.m. checking pre-market charts. I used to be one of them, but then I realized a brutal truth about wealth. It doesn't matter how fast you make money if your portfolio can't survive a storm. That is exactly why I recently deployed a massive chunk of capital to buy exactly 500 shares of Johnson & Johnson. At current market prices, that is a position worth roughly $80,000. Now, to the aggressive growth investor, this sounds incredibly boring. JNJ isn't designing autonomous robots, they aren't building microchips, and they certainly aren't going to double your money overnight. But while everyone else is chasing volatility, I built a financial fortress. In this video, I'm going to break down the exact math behind my 500 share position. I'll show you how much cash this single company deposits into my bank account every single quarter, why this stock functions as the ultimate retirement anchor for my portfolio, and the hidden risks that most investors completely ignore. If you want to build a portfolio that lets you sleep through a recession, drop a like on this video, hit subscribe, and let's look at the numbers. Before we look at the specific financials of Johnson & Johnson, we need to understand a fundamental concept in portfolio architecture, the retirement anchor. When you are young, your portfolio can afford to be top-heavy with growth. If a high-flying tech stock drops 40%, you have time to wait out the recovery. But as you build real wealth, your priority naturally shifts from aggressive accumulation to wealth preservation and predictable income. An anchor stock has three non-negotiable characteristics. Inelastic demand. They sell products that humanity literally cannot live without, regardless of whether the economy is booming or in a deep depression. A pristine balance sheet. They possess more cash and financial stability than some sovereign nations. A history of relentless payouts. They don't just pay dividends, they raise them every single year, outpacing inflation automatically. Think about it this way. If a massive recession hits tomorrow, people will stop buying new cars. They will cancel their streaming subscriptions. They will skip their luxury vacations. But will they stop buying oncology medications? Will hospitals stop buying surgical equipment, joint replacements, or cardiovascular devices? Absolutely not. By purchasing 500 shares of JNJ, I didn't just buy a ticker symbol. I bought a fractional ownership in a global healthcare titan that has survived world wars, inflationary crises, high interest rate environments, and global pandemics. Let's get into the raw math. Let's look at exactly what 500 shares of Johnson & Johnson looks like under the hood. Assuming an average purchase price hovering around $160 per share, a 500 share position requires a total capital outlay of approximately $80,000. Now let's look at the dividend metrics. As of recent filings, J&J pays an annualized dividend of roughly $4.96 per share. Let's break down what that means for my passive income stream. Timeframe calculation, total passive income. Per quarter 500 shares x $1.24, 620s. Per year 500 shares x $4.96, 2,480s. Every 3 months, like clockwork, $620 lands in my brokerage account. I don't have to manage properties, I don't have to deal with tenants, and I don't have to sell a single share to access that cash. But here's where the true magic of a retirement anchor comes into play. The dividend reinvestment plan, or DRIP. If I choose not to spend that $620 every quarter, my brokerage account automatically uses that cash to buy more fractional shares of J&J. In quarter 1, I own 500 shares. In quarter 2, those dividends buy me roughly 3.8 new shares. Now I own 503.8 shares. The next dividend payout is calculated based on 503.8 shares, not 500. This creates a snowball effect. The dividends buy more shares, which pay more dividends, which buy even more shares. It is a self-compounding machine that builds momentum completely independent of whether the stock market is going up, down, or sideways. Paying a dividend is great, but any company can pay a dividend for a year or two when times are good. What happens when the economy falls apart? This is where Johnson & Johnson enters an elite tier of corporate history. J&J is a certified dividend king. This means they have not only paid a dividend, but they have actively increased their dividend payout for over 60 consecutive years. Think about the sheer scale of global chaos that occurred over the last 6 decades. We had the stagflation of the 1970s, the dot-com bubble burst, the 2008 global financial meltdown, and a modern pandemic. Through every single one of those catastrophic events, J&J didn't just maintain their dividend, they gave their shareholders a raise. Furthermore, Johnson & Johnson is one of the incredibly rare corporations to hold a AAA credit rating from Standard & Poor's. To put that into perspective, there are only 2 companies in the entire world that hold this rating. J&J's credit rating is actually higher than that of the United States government itself. It means rating agencies look at J&J's balance sheet, its free cash flow, and its debt management, and determine that it is one of the safest financial institutions on the face of the earth. When you are structuring your retirement, this is the exact type of predictability you need. You can't pay your grocery bills with volatile valuation metrics. You pay them with reliable cash. Now, if you are a sharp investor, you might be thinking, wait a minute, isn't J&J the company that makes Band-Aids, Tylenol, and baby powder? Historically, yes. But recently, J&J underwent one of the largest corporate restructuring moves in its history. They spun off their consumer health division into a completely separate, publicly traded company called Kenvue. Today, the Johnson & Johnson that I own 500 shares of is entirely focused on 2 high-margin, hyper-advanced sectors: innovative medicine, pharmaceuticals, developing cutting-edge therapies for oncology, immunology, and neuroscience; medical devices, creating advanced robotic surgery systems, orthopedic implants, and cardiovascular tools used in operating rooms worldwide. By removing the slower growth consumer products division, J&J essentially unlocked a higher margin business model. While consumer goods offer stability, pharmaceuticals and medical tech offer pricing power and massive long-term growth runways as the global population ages. According to global demographic data, the number of people aged 65 and older is expected to double over the next few decades. An aging population means an exponential increase in elective surgeries, chronic illness treatments, and medical interventions. J&J is perfectly positioned right at the intersection of this massive macroeconomic trend. As an authentic investor, I will never tell you that a stock is 100% safe. Every investment has risks, and J&J is no exception. Before you ever consider putting your hard-earned money into this stock, you must understand 2 major headwinds. First, there is litigation risk. J&J has faced massive, multi-billion-dollar lawsuits over the years regarding legacy products like their talc-based baby powder. While the company has billions in cash reserves to settle these legal battles, the headlines alone can cause short-term stock price volatility and drag down investor sentiment. Second, there is the pharmaceutical patent cliff. When a drug company develops a blockbuster medicine, they get a patent that protects it from competition for a set number of years. When that patent expires, cheaper generic alternatives flood the market, which can cause a drop in revenue if J&J doesn't have a strong pipeline of new drugs to replace it. This is exactly why J&J reinvests billions of dollars every single year back into research and development, R&D, and strategic acquisitions. They don't just sit on their past success, they actively buy and build the future of medicine. I didn't buy 500 shares of Johnson & Johnson to get rich quick. I bought them because I am already focused on staying rich, protecting capital, and ensuring that no matter what happens to the broader economy, my financial foundation remains completely unshakable. Your retirement anchor doesn't necessarily have to be J&J. It could be an index fund, a basket of blue-chip dividend growth stocks, or high-quality real estate. The lesson here is about balance. Don't let the noise of the market distract you from the power of boring, consistent compound interest. Find your anchor, build your foundation, and let time do the heavy lifting. If you found value in this breakdown, make sure to smash that like button, leave a comment below letting me know what your ultimate anchor stock is, and I will see you in the next video.